If you were ever studying a stock and wondered to yourself, are the big institutions, the people with the deep pockets that could really move a stock around, are they accumulating or distributing this stock? Well, relative strength analysis is the perfect tool for you. Today, in just 5 minutes, we're going to cover the 4 most common methods for relative strength analysis, and I'm going to explain how you could really easily incorporate it into your trading process. So let's get started. You know, relative strength at its simplest is really just measuring performance. That's all we're doing. You're looking at how is the stock acting versus an index, how is it acting versus other stocks on the exchange, and you can look at different time frames, the past 12 months, any kind of different period. And you're really trying to see how is the stock performing, how is it already done. So a lot of people, the first the kind of thing that will come up is someone will say, how is that relevant for what's coming next? Well, I would argue there's a lot of relevance, because the fact that the stock has already outperformed other stocks in the index is telling you a lot of critical information, which we're going to get to in a second. But put yourself in the shoes of a general manager of a sports team. Let's say you have to fill a position on the team and you're going to be looking around the league to see who you're going to make an offer to. What's the first thing you're going to look for when recruiting somebody? You're going to look at who already performed that role very well, who's already going to be a standout for that position. There's other metrics you're going to look at too, of course, like, are they injury prone? Are they good team players? How old are they? How much do they have left in their career? But their performance is going to be a key metric because it proves that they already have the skill set to succeed in the role you want them to perform. It's not going to be on-the-job training. They already know what they're doing. So if you kind of take that viewpoint and you look at stocks through that lens, you're getting that same kind of information. An outperforming stock already tells you some really critical information about the stock itself. So first off, if the stock's outperforming, it's already getting flows from institutions. The people who have the money to buy and a lot more money behind them have already identified that this company is doing something well. So that you already have that flow and that eye from institutions. Now, you only have that flow and that eye if management has been able to articulate why this company is a good investment, because trust me, the big institutions spoke to management, and they've been able to kind of deliver on the promises they made. And lastly, management has only been able to kind of deliver on these promises if there's actual demand and there's good execution to get these products and services to the market. So, people actually want what the company's selling, and they're able to get it to these people in an efficient way. So with an outperforming stock, you already check off all of those critical factors. Institutions have found the company. Management's capable. There's demand for the product and service, and the company can execute on getting it to the market in an efficient way. So that one metrics, you're just looking at what the stock has already done, but you get a ton of information out of it. So let's dive in now into the 4 main ways, the 4 most popular ways to measure this relative strength analysis. So one of the most helpful measures is the composite relative strength, which is available typically on Investor's Business Daily. It was written about and spoken about by legendary investor William O'Neill. What William O'Neill did with this metric was basically he just ranked how did all of the stocks perform over the past 12 months and ranked them in a percentile method. So if you get a rank of 99, you've outperformed 99% of all other stocks. If you get a rank of 1, you're the worst performer of the past 12 months. With that one simple number, just by breaking it into buckets of percentile, you can know right away how your stock ranks over the past 12 months versus every other stock on the exchange that's listed in the United States. Now, you can do this on any exchange throughout the world, but Investor's Business Daily publishes the numbers for the US. Now, this is a really helpful stat because it serves very well to searching and filtering through stocks. So if you say, look, I just want to look at the top 5% of performers over the last 12 months, you specify I want to have a composite rank rating of 95 or higher, and right away you've eliminated 95% of stocks out there, and you're looking only at that 5% that cream of the cream, the top performers of the past 12 months. So that's one of the real helpful aspects of that tool. Now, one less helpful form of that method is essentially you can only really apply it to other stocks that are already listed. So you can't compare what is my stock doing versus the S&P 500. This is a ranking of all stocks. So you can't specify how the performance is going versus an index or a benchmark. So if you want to know, for example, is my oil stock just the best oil stock? Or is the S&P doing better than the NASDAQ 100? That type of analysis won't really help you out. So that's kind of where we fall into this next form of analysis, which is the relative strength line. This is the preferred method by technical analysts. Essentially, you take the security you're interested in. Let's say you want to take a look at Apple and you want to compare it to the S&P 500. You want to know, is Apple outperforming the S&P 500? And so you just take the price of Apple, divide it by the S&P 500, and you get this relative strength line. So if we take a look at this chart of McDonald's, I feel the relative strength line that you can see at the bottom of this chart really tells the story of McDonald's in 2023. I mean, so first of all, in March, you can see there's this positive divergence. You know, the McDonald's stock price is making a lower low. It's heading down, but you can see the relative strength line of how McDonald's is performing versus the S&P 500 is already starting to climb. So despite McDonald's is heading lower, it's doing better than the index. So that's kind of telling you that there's already money flow moving into this security, and that preceded the advance that McDonald's went on. Now, interestingly, in July, as McDonald's was kind of putting in a top, you can see the opposite start to form. You know, the S&P was going up, but suddenly McDonald's starts to put in a negative divergence. You know, the stock's going up, but the relative strength line is starting to already kind of move lower. So this relative strength line, in a really kind of simple way, can show you these divergences over different periods of time where the stock is either outperforming or underperforming, and it's giving you an insight as to whether or not there's accumulation or distribution going on in the stock. In the background, you can see it, how is it acting relative to the S&P, and that gives a good glimpse into whether or not money is flowing into or out of the stock. So the relative strength line is very helpful. However, I found some drawbacks. So when I was a market maker, I would trade very often the gold stocks, and you're always going to be comparing the gold stocks to gold. Now, it's interesting because gold is one of the safest, one of the least volatile assets in the world historically, and even in regular times. Whereas gold stocks are the complete opposite side of the spectrum. I mean, they're incredibly volatile. Their assets can be seized by governments. They could have water problems at their mine. They have a lot of debt. I mean, so they're very sensitive to the gold price. So during my time as a market maker trading these stocks, I would notice this relative strength building up and weakening, but I had to go a step further. I had to build what I call adaptive relative strength. I had to factor in the volatility of the security versus what I'm comparing it to. So for example, what I mean by that, just really simply, let's say a gold stock is usually 4 times more volatile than gold because it's so much more erratic. Well, if gold is up 1% and the gold stocks are up 1.5%, on the surface, it looks like, wow, the gold stock did great. It outperformed gold. But it didn't outperform it enough given how jumpy it usually is. It should have been up 4% or more because it's usually 4 times as volatile as gold. So by incorporating that level of volatility of the security versus what you're comparing it to, you get a much deeper form of relative strength analysis. So if we take a look at this next chart, we can take a look at Tesla. And I built this tool called Caruso Adaptive Relative Strength where it factors all of this in and it looks at this volatility adjusted relative strength over different time frames, and it comes up with this simple blue background for analysis. Now you can see here all of the nice uptrends in Tesla over the past year took place with relative strength from Tesla. You can see the blue background comes off, and then as the stock kind of runs out of steam, you can see we go back to just a regular white background, meaning it's no longer outperforming the S&P 500. So this is really helpful because you can compare any 2 assets together. You can compare a utility stock versus the S&P. You can compare a very volatile stock or a more volatile stock, let's say like Tesla, or a technology stock to the S&P, and you can always get the relative strength analysis factoring in that these companies are just very different from each other. Now that could be a little more complex. So I get it if some people don't want to go that far in their analysis. So there's another way you can kind of factor that volatility into your analysis by just studying the stock chart itself. So if you take a look, for example, at race, what I like to look for divergences between the stock price and the index itself. So because the stock has its own volatility, this will kind of get factored in because if let's say, for example, the S&P is making lower lows, regardless of the volatility of the stock you're looking at, it should probably be making lower lows as well. So if there's a point in time where the S&P 500 makes lower lows and your stock does not, you get this positive divergence. And that's a very important relative strength that also factors in that specific stock's volatility. So if we take a look at the chart of race here, Ferrari, you can see here in October of 2022, despite the S&P kind of breaking lower and making lower lows, Ferrari was no longer making lower lows. It was making a higher low. I guess the irony, despite a bear market, people still want Ferraris to drive. But that situation preceded what was a really big advance in the stock price of Ferrari, of race. And so you can kind of compare that for stocks, that when the S&P is heading lower. Similarly, if the S&P is making higher highs, you can look for stocks that are not able to make a higher high along with the S&P 500. Now, this is more relevant, of course, for stocks that move similar to the general market. For example, if you're comparing an oil stock to the S&P, depending on what oil is doing, it may not be relevant. But especially if you're looking at two kind of related securities, I find this to be a really helpful, really simple way to look for this kind of divergence relative strength between the stock or the security and what you're comparing it to. So as you can see, with these four different ways, and they're all very different from each other, you can all get these really important glimpses into the relative strength of the stock or the security you're looking at. And it typically will always precede either a big advance. You'll see these big periods of accumulation, this positive relative strength at the onset of a move. And by the time that stock is kind of running out of steam and the big funds are beginning to distribute that stock, you can see that relative strength goes away. The weight of that selling no longer allows the stock to outperform its benchmark or its peers. So I hope you found this very helpful. This is just kind of scratching the surface of these four different methods and how they can be helpful and easily incorporated into your approach. They all have their pros and cons, but I think they're all very helpful. And I really use all four methods in my analysis all the time. It always helps to kind of point me in the direction of where the money is flowing and keeps me on trend. I hope you enjoyed this video. If you did, you can follow me on Twitter at trader_mcaruso. You can visit me on my website, carusoinsights.com. If you want more information about that Caruso Adaptive Relative Strength, there's a link below the video. Thanks so much for your time, and talk to you soon.